here in February of 2023, we're almost 1 year away from the Fed's first rate hike. It was March of 2022 when they hiked interest rates initially, and only in September did they start to reduce their size of their balance sheet. So we're less than a year away from the first hike, and we're less than 5 months removed from the beginning of quantitative tightening. So given the normal lag between interest rate hikes and when it impacts the economy, we think that in this calendar year, 2023, the US economy will start to slow, and we think there's likely to be slowing economic growth around the world. So as we thought about the 10 surprises for 2023, we wanted to describe a world in which economic growth is more challenged and there's a high probability of recession, but that markets are not the economy. Stocks are not the economy. And because of the volatility and the declines that we've seen already in markets over the course of the last 12 months, and more attractive valuations in some part of the world, particularly in Europe, with high quality assets, and in Japan and Australia and other parts of the world, we think there will be opportunities to deploy capital. So at Blackstone, we're looking at the possibility of short-term volatility as a friend. And historically, in eras of dislocation, we have produced some of what we feel are our strongest vintages. So as volatility increases over concerns of the impact of higher rates, we think there'll be opportunities to deploy capital. And as long-term investors, the entry multiple, the price at which an investor pays to get into an investment, ends up being one of the most important variables in determining long-term performance. And we've seen valuations adjusting, we've seen currencies adjusting, and as a result, we think there'll be significant opportunities to deploy capital in 2023. So the background behind this year's 10 surprises were a more challenging economic environment, but a world in which we do see opportunities beginning to develop. And as we wrote in the 10 surprises this year, we could see a recovery that rivals the recovery that we saw in 2009. So overall, while we're more concerned about the direction of the US and global economies, I would describe us as more optimistic about the coming investment environment. So that was the thought process behind the 10 surprises. I want to now turn to several charts to help illustrate those views. And the first section is going to cover the economy and inflation. And in the first chart, what I want to highlight is just several markers that will provide a leading indicator, that act as leading indicators for when economic cycles will turn. And what we're looking at here is surveys of businesses, the Institute for Supply Management, as well as a survey of purchasing managers. It's called the Purchasing Managers Index. And on the left-hand side, you can see that historically, when the ISM falls below 50, it's consistent with a recession, and the recessions are in the gray bars. ISM recently fell below 50. On the right-hand side, you can see the Purchasing Managers Index, and this is new orders. This is when companies are placing new orders, and you can see below 50 represents a contraction. What that says is that companies are becoming more defensive. They slow down their orders. And historically, when it falls below 50, it's consistent with a recession, again, which is represented in the gray bars. So this tells us that conditions are becoming more challenging. In the next slide, we look at housing activity in the United States. Housing is about 17% of GDP. And we've seen a 35% drop in housing starts. That is a really significant contraction in housing activity. And you can see historically, going back to 1959, a 35% contraction in housing starts is consistent with recessionary conditions. You can see that its track record is not perfect, but as a pretty significant contributor to economic growth, when housing activity slows, it starts to represent some significant challenges. In the next slide, we look at yield curves. And my team and I have always considered a yield curve to be the most accurate predictor of economic cycles. A country's yield curve is generally going to be their best economist. Now, what the yield curve is looking at is the difference in yield between a 2-year government bond and a 10-year government bond. And when the yield on the short-term bonds is higher than the yield on the long-term bonds, that's considered an inverted yield curve. Because in a normal, healthy, functioning economy, the longer the maturity of the bond, the higher the yield. So it's very unusual for short-term bonds to yield more than long-term bonds. And historically, that tells you there is a recession coming. So on the left-hand side, what we're looking at in the dark green line is the number of countries whose yield curve is inverted. We follow about 23 countries on a weekly basis, and more countries today have an inverted yield curve than any time in our history of the data, even more so today than during the Great Financial Crisis. And on the right-hand side, we're looking at the average spread between the 10-year and the 2-year for major countries. And you can see that that spread is almost zero. The inverted yield curves in the flat rate environment, again, is a warning sign to the global economy. The next slide looks at inflation. And what we wanted to illustrate here is the future path for CPI. And we illustrate 3 different scenarios because inflation is clearly rolled over, but the most recent data is leading people to question how quickly deflation will unfold. And the Fed has a 2% inflation target. So the big question is, how quickly can the Fed get back to 2%? So the solid line is actual inflation. And then we lay out 3 different scenarios: an optimistic scenario, a base case, and one in which inflation falls more quickly. And the way that we arrived at these 3 scenarios was to take different inflation regimes in the past and project that into the future. The green line, where you can see inflation actually starts to accelerate in the second half of the year, represents what happens on a monthly basis if we simply take the inflation average over the last 2 years and project it to the future. Inflation's been running hot, and so if inflation on a month-to-month basis averages the same as the last 2 years, then we end up with very high inflation very quickly. The next line, the darker green line, is we're looking at what if on a month-to-month basis, price changes average what they did from 2009 to 2019. So in other words, what we're looking at with the dark green line is what will happen if the monthly increase in prices sort of falls back to pre-COVID levels. We can get back to around 2% inflation, 1.8%. And then the third line is what happens if all prices stop increasing. So this is just a hypothetical example. I think one of the challenges is that there is a floor on deflation, and that floor is going to be set by wages. If we turn to the next slide, I want to illustrate the labor shortage in the United States, and I would focus your attention on the right-hand side. On the right-hand side, in the light green and dark green area, we have added up the total number of jobs, both including openings. So that's existing jobs as well as the total number of job openings. And the gray line represents the number of available workers. And there is still a massive labor shortage in the United States, and that continues to push wages higher. On the left-hand side, what I would point your attention to is if you look at the average hourly earnings growth, look at the period from 2009 to 2019. Wages were growing at about 2.5% to 3%. Around 2.5% wage growth would be consistent with the Fed's inflation target, but you can see wage growth remains elevated. Inside of our own portfolio companies, and at Blackstone, we own 250 portfolio companies that collectively employ 700,000 people. The wage growth inside of our own portfolio companies is running hotter than the wage growth on the left-hand side of this chart. In our own portfolio companies, we expect to take wages up by approximately 5% this year. So as we look at inflation, the easy to solve parts of inflation, I think, will continue to come down, but wage pressures remain too hot, and there's still a shortage of workers. Now, I want to turn to the consumer. And on the next slide, what I want to illustrate is excess savings. Now, I'm sure a lot of the people on the Zoom have been reading about the excess savings in the United States and in so many other parts of the world. And that savings increased because, number one, so many economies were locked down over time. And number two, so many governments around the world created fiscal stimulus programs that transferred money directly to households. On the right-hand side, you can see that in the United States, the excess savings, which is savings above what was there pre-COVID, hit $2.3 trillion by the beginning of 2022, but that's now down to $1.3 trillion. So households over the course of the past 12 months spent $1 trillion of that 2.3 trillion in excess savings. And you can see that on the left-hand side where we look at quarterly flows. You can see when the black line is positive, people are increasing their savings. But you can see a combination of income and fiscal support and consumption means that on a quarterly basis, the savings was being worked off or turned negative. The consumer is going to soon run out of steam, and I think consumer spending will begin to come down. Now, the next section, I want to turn to the Federal Reserve and markets, and I want to make just a couple more points. So the first slide I want to look at here is looking at short-term interest rates around the world. I'd mentioned that this is the most coordinated tightening environment we'd seen in history. But when you look at this chart over time, you see that despite the aggressive hiking of interest rates, global rates are still relatively low. And I think they're going to have to continue to go higher. I think we'll see more tightening in 2023. I think the Federal Reserve will have to hike interest rates at least 2 more times. The consensus is that the Fed will have to take up rates possibly even 3 more times. If you look at the Federal Reserve's own projections, they see their interest rates going above 5%. So around the world, I think we'll continue to see the short rates go higher, and this is going to slow economic growth and contribute to volatility in the markets. If we look at the next slide, this is looking at how the Federal Reserve is reducing the size of its balance sheet. This is another form of tightening. And what we're looking at here is the balance sheet level. The green is the actual level, And you can see the Federal Reserve took its balance sheet from just under $4 trillion in 2020 to almost $9 trillion by January of last year. And now the Federal Reserve is starting to reduce the size of its balance sheet. And you can see that on the right-hand side. This is another form of tightening. When you look at the federal funds rate, it's around 5, it's just below 5%. But when you add in the effects of quantitative tightening, the effective Fed funds rate, the combination of tightening rates and reducing their size of their balance sheet, pushes the effective rates to over 6%. This is the highest level in the United States since at least 2007. This is going to slow economic growth and, again, I think contribute to volatility. Now, if you look at the next slide, historically, when the US enters a recession, corporate profits fall. If you look at every recession since 1950, that's 70 years of data, going into every recession, corporate profits decline by an average of around 20%. On the right-hand side of this chart, what we look at is the earnings drawdowns in different recessions. In 1974, 1975, 1980, and 1981, 1883, I would highlight these three in particular because they were recessions with higher inflation. And you can see the earnings decline was not as bad as recessions with lower inflation, which was 1989, 2000, and 2007. So if we do enter a recession, which is, in my view, we will, I think we could see earnings decline. And on average, that decline in inflationary periods is a little bit lower, but it still represents an earning decline. The next slide I want to highlight is looking at the cost of servicing US government debt. On the left-hand side, we look at the maturities of government debt, and almost 50% of US government debt matures in the next 3 years. And that's going to have to be refinanced at a significantly higher interest expense. The weighted average coupon of US government debt today is 1.83%. But they're going to be refinancing that debt at 4.5% to 5%, which is where short rates are today. The debt service is going to rise significantly. And you can see that on the right-hand side, where we look at debt expense, the interest cost as a percent of GDP, it could very easily double from here. And that's going to be a source of drag. The last slide I want to highlight before I turn over back to Aaron for questions is, I think over the next cycle, which is not the next 6 to 12 months, but over the next 3 to 5 years, I think the real economy will outperform the financial markets. From 2010 to 2019, in an era of low rates and quantitative easing, asset prices outperformed the real economy. So in other words, what you had was, with quantitative easing and zero rates, the money flowed into financial assets, and those financial assets outperformed the real parts of the economy. In 2020 and 2021, with massive amounts of quantitative easing, asset prices outperformed the real economy. But in 2022, when we saw rising interest rates and less liquidity, the real parts of the economy outperform. I think the next cycle with less liquidity and higher rates is going to mean that companies that can produce cash flow and assets with shorter maturities and shorter durations, and assets that have the ability to increase their cash flow or their interest rates, will outperform, because I think we move into a more challenging environment where we have a change in leadership. And the leadership, in my opinion, goes from more speculative financial assets to the assets that are tied to the real economy, and those that can increase their cash flow and increase their interest rates in response to what I think will be a more volatile inflationary period. So those are the slides I want to cover. With that, Aaron, I'll turn things back over to you for questions. Thank you.
Thank you. Thank you, Joel, for your presentation. I think there are a lot of points for our audience to digest today. But now I just want to quickly borrow the time to ask you two questions. I think most of our clients are really concerned. Joel, you just shared in your presentation, there's tightening in rates, shrinking in Fed's balance sheet, plus the signals from leading indicator inverted yield curve. I think one first question will be in case of a recession, do you think U.S. likely to hit a soft landing or a hard landing?
Aaron, that's a great question. And there are two things that I think will help determine the difference between a hard landing and a soft landing. First is how long the Federal Reserve needs to keep rates at elevated levels. And it's my own view that the Fed will not be able to cut rates in 2023. The Fed has made it clear that they're going to hold rates at these levels or higher until 2024. The longer the rates stay elevated, the more damage it does to the economy. And the United States economy is not only at risk to US rates, where there's about a 38% correlation between the Fed funds rate and US GDP growth, but the US is also significantly exposed to global interest rates. There's a 45% correlation between the US economy and the movements in global interest rates. So as central banks have a harder time taming wage inflation because of labor shortages, I think rates have to go higher for longer. And that, in my opinion, will create conditions consistent with a recession. The second question is, how deep does that recession go? And if you want to try to forecast the depth of a recession in the United States, one has to take a view on household net worth, because changes in household net worth determine how deep and how long a recession goes, because the US economy is all about consumption. We're not a manufacturer, we're not an exporter, we are a nation of consumers. So household net worth is very intimately tied to how consumption in the United States will evolve. So if you look at household net worth, it comes down to the value of housing. Here, I'm relatively optimistic because housing is not, there are not excesses in housing. We don't have excess supply. We don't have excess speculation. We have very little leverage in housing, and lending standards are still historically high. So there's very little excess in housing markets, in my opinion, which will limit how much household net worth is impacted. So I think that ends up being a silver lining for how long a recession might go. I think we will see volatility, and in the volatility, I think we have the opportunity to deploy capital. So hopefully that helps.
Thank you, Joel. May I ask a second question? I feel like, due to timing, let's just quickly find your recommendation for the clients in terms of asset allocation. What do you suggest to the, Cathay's client today, given the, all the macro backdrop you just highlighted?
Well, thank you. I'll very quickly make 2 points. The first point is on asset allocation. In 2022, we saw a historically bad drawdown in a traditional portfolio of 60% stocks, 40% bonds. A traditional 60-40 portfolio had one of the worst drawdowns in the history of the data. And the bonds and stocks were positively correlated, meaning you did not get the diversification benefit. And if you look at the relationship between stocks and bonds, in periods of higher inflation and higher interest rates, prices of stocks and bonds tend to move together. So in other words, in periods of higher inflation, one does not get the diversification benefit of stocks and bonds. So the first point I would make on a portfolio allocation for this environment is that I think investors will need to incorporate more asset classes to build a truly diversified portfolio. And in my opinion, that should include alternatives and private market investments. They can provide a diversification benefit, and with lower to negative correlations, it means that they can reduce risk while providing the opportunity for return enhancement. Secondly, I think across asset classes, current cash flow or the ability to grow cash flow or grow income will be one of the most important variables or keys to outperformance. Because in an era of low rates, one is paid to speculate. In an era of zero rates, one is paid to speculate even further. But with higher rates, the current income and the ability to grow that income ends up being one of the most effective hedges to the inflationary pressures and higher interest rates. So I think cash flow and the ability to grow cash flow across any investment will be one of the keys to outperformance. So with that, Aaron, I'll turn things back over to you and say thank you.